Welcome to Live from the Compound. I am your host, Downtown Josh Brown, here with my co-host, as always, Mr. Michael Batnick. On today's very special episode, we are joined by one of the most popular and the most requested and re-requested guests in compound history, Mr. Michael Cembalest. Michael's work has shaped how professionals and institutions think about markets for decades. He is the chairman of market and investment strategy at JPMorgan Asset and Wealth Management. He authors the widely followed Eye on the Market, a research publication known for its sharp analysis, irreverent tone, and deep dives into the market, the economy, geopolitical issues, etc. Over 35 years of experience, Michael is one of the most respected investment strategists on the street. Welcome back to the show. We're so happy to have you.
Thanks very much.
How's that for a build-up?
And that was all off the dome. Very impressive.
There's more. So we invited you here to celebrate the 20th anniversary of a publication Michael never misses, I never miss, and it's called Eye on the Market. If you work in finance, it's very likely you get this sent to your inbox. And the 20th anniversary is a really big deal. And I think what we want to do today is really talk about some of the most memorable charts and some of the biggest insights that you've produced over the years putting this out. And I just want to say thank you so much for joining us in studio. It was so much fun for me to go back and read some of these because I read them in the moment. And one of the questions I kept asking myself was, did I pay enough attention to this at the time that it came out? What was your experience like going back through your own work?
Let's see. Well, our chart formatting was pretty crappy when we started.
Okay, fair.
The pieces were shorter.
Yeah.
Particularly before the financial crisis when the world was simpler. But then once the financial crisis hit, the cadence of it went up. At one point, we had to publish like every week. The week that Lehman went into defaulted and then the GSEs were put into conservatorship, we published 3 times.
Yeah.
So we wrote a lot more often back then because there was a lot of things to plow through.
So I want to go back to the beginning. You've done 4,500 pages worth of Eye on the Market.
Right.
But like that's the page count.
It's called. We have this file called the Eye on the Monster, and it's every Eye on the Market that's ever been written.
Okay.
And there's 584 of them.
Was it always Eye on the Market? Was that the first name?
Before that, I wrote a semi-annual publication called On My Mind, but it was for a few years before that. But Eye on the Market started in 2005.
Okay. So Mary Callahan Erdos comes to you and says, You're doing a lot of research for the in-house client call,
right?
Which is like an 8 a.m. or 7 a.m.
Right. And yep,
right. Okay,
and I was the chief investment officer in the private bank at the time.
Okay,
and she wanted me to start sharing externally to the extent that we could disclose what we were thinking about different portfolio strategies.
So this is 2005. Did it start as an email product, or were you physically
It started as an
it?
email, except a lot of our clients didn't have email.
Right.
So we had to print them and then snail mail them at times.
Okay. All right. So
and people were still using Palm Pilots.
So this is how Mary puts it. She refers to Eye on the Market as, quote, one of the most widely respected pieces of thought leadership in our industry. I think most people would agree with that. Jamie Dimon has referred to your Eye on the Market series as, quote, required reading. I'm guessing the success of the series has surpassed your wildest expectations from when you were 35 years old and they came to you and said, hey, how would you like to put this out on a regular basis?
35 years old?
35.
How old were you started?
Your math sucks.
All right, sorry.
I was 45.
45. Okay, my bad. But I'm guessing from the day you started,
right,
they must have, like, this must have gone so much bigger than you ever thought it would have.
Yeah, I mean, it took a while, right? I mean, you have to compete for space. There's a lot of people get a lot of stuff in their inbox. And, you have to get some calls right. You have to get some important calls right. You have to make it clear when you make the wrong call, what you learned and how you're going to try to avoid the same thing. But yeah, over time, it started to pick up speed.
What do you think was your best call?
A few things kind of jump out.
The subprime stuff.
The subprime
I mean, not that you peaked early, but like you had really fortuitous timing.
I saved an email that I sent to Jamie in the fall of 2006 saying, I've heard rumblings that the bank is about to start up a subprime effort. I think that would be a huge mistake. Let me tell you what we see going on underneath the hood in terms of leading indicators, delinquencies, defaults, and recoveries.
Yeah, I think so. I think I had not read that, but that's '06. You're talking about subprime 18 months before it becomes the linchpin of something really monstrous for the market. And I know you stuck with it. You didn't just write about it once, but I noticed that you started right there with this particular compilation.
Yeah.
Why was it important to do that? Was that like setting the table to just show like, look, we said some really important stuff?
Yeah. I mean, I didn't want to start the compilation with a 2020 hindsight piece after the financial crisis had already happened. I wanted to make it clear that we did see some of the elements coming. I had absolutely no idea that the GSEs were in such bad shape that they were going to be put into conservatorship. Yeah. But we did start the year underweight credit, high yield specifically, and equities in 2008 because of these kind of concerns. And, you know, I actually thought the Lehman bankruptcy was going to be the bottom, and then we got a whole nother bottom after that.
It was 6 months before the bottom,
right?
It was a bottom.
That's right.
Okay, when you started to get feedback for this, and coming from people outside of JPMorgan, so you start publishing, it starts going out. What is the early feedback like? Super encouraging and makes you want to keep going, or are there people taking issue with what you're saying, or what was that like?
Well, the more opinionated you are, the more people have issues with it. People send in things and then legal people deal with them. And, usually you get the strongest reaction to things that don't have to do with markets. I mean, market outcomes speak for themselves. And there's not a lot to debate after the fact about what a market outcome was. People tend to get themselves, all twisted up when it comes to policy issues, energy, vaccines, and things like that. Penguins, people, and politics in particular. And that's when people kind of get very opinionated about things. But you can't write something that's strongly opinionated and not have a high tolerance for people that disagree with some of the things that you say.
I actually would take that further. There are a lot of people who have decades-long careers on Wall Street, and their primary skill set is saying absolutely nothing at all times. And for a lot of investment firms, a lot of banks, a lot of asset management firms, that's actually all they want. They want someone who's the face of the firm, who never disagrees with anyone vehemently, never offends, never pisses off a client, and just right down the middle, here's the most plain vanilla version of events. And you very obviously have staked out opinions, and you've gone the other way, and the bank has stood with you for the most part. I think you said only twice has content been shelved.
Yes.
That you've done for Eye on the Market.
Are we allowed to reveal? It's in the past.
We could say what they were. Can I guess?
Is that where you want to go?
Let's start there.
In the beginning of the podcast?
Let's start there. Okay. You probably said jet fuel doesn't melt steel beams.
Wow.
No? Okay.
Oh my gosh.
What did you say that was? What did you say that was so crazy?
Is he's not like a truther?
No, not at all. What did you say that was like so controversial that they didn't put it out?
In March 2021, I wrote a piece on the mounting scientific evidence that COVID was an accidental lab leak.
Yeah.
And
I could see that.
And I talked to a wide number of hematologists. And the sad thing was that a lot of them felt this way but didn't want to go public with it. Yeah. But I had the piece written, and the firm decided that it would be too problematic for China and could negatively affect our business in China. And the firm's been trying to do business in China for a long time. And so that piece got shelved.
I mean, not a lot of upside to publishing that.
I was going to say, were you relieved when they said, thank you for doing this work, but we don't think it's...
No, I thought it was pretty... Given all of the competing narratives at the time, I thought it was important for people to understand that the paper that was written in February 2020 in The Lancet talking about how, it's definitely a zoonotic jump and there's no debate about it, was really bad science and irresponsible. And so I wanted to publish the piece, but it got shelved. I understand why it got shelved, but it got shelved.
The piece would have been used for political purposes in the news. It would have become it would have taken on a life of its own, far beyond the perfectly legitimate research purpose of why you wrote it.
Yep.
Okay. What was the other instance?
The other one happened this year. There's certain details I'm going to sanitize.
Fine.
But a couple of our operating committee members wanted me to write a piece on the executive orders against the law firms when they first started happening, and how it was corrosive to good government and negative for the markets and negative in terms of a signal of how the administration was going to be dealing with individual companies and firms and issues. So I wrote this piece, and I started out by saying that defending corporate lawyers was a rather unpleasant task, and I wrote about the piece was called "The Plumbing Snake," because I wrote about how in my family I'm the one that has to unclog toilets and pick up dead animals from the yard, and which is kind of like defending lawyers is on the same level as those unpleasant things to do.
Quite an analogy,
right? And but now that I'm going to do it, here are the reasons, with looking back at 200 years of history, as to why this is bad for investors and bad for the United States. And
these are the law firms that had launched lawsuits against Trump in the first term,
or simply had people working at them.
Yeah.
Who in some years prior were involved with some litigation against the president.
Right. Okay.
And this is different than, like, some people may not agree with the president's policy with respect to cutting NIH funding or CDC funding, but he ran on that. Some people, and people elected him for it. Some people don't like his immigration policy. Some people don't like his policy with respect to the Supreme Court. But all of those things he ran on, and voters voted. The law firm thing was different. That was something that was very personal to the president, and I think not in a very kind of constructive way for the investment community. But other operating committee members felt that it would just put a target on the firm's back, and it was inappropriate to publish, and that was the only one that was killed.
Okay, so I guess I would take it a little bit further, and then we can move on.
Sure.
But I'm sure there's some interest. JPMorgan and Wall Street firms engaged in a lot of M&A, and now there are a lot of personal issues with particular companies that want to do deals.
Mm-hmm.
And it seems that the market is not really particularly concerned right now. They think deals will get done. You just have to do and say the right things. Is that something that you think you might be writing about? Or
I don't know. We'll see. There was a lot of excitement about Lena Khan leaving, her post, and how the DOJ and the FTC would have a more pro-merger approach to policy. Interestingly, Vance has misgivings about business consolidation, and so do some other people in the administration who are not necessarily in favor of the kind of classic Sherman Act approach to M&A approvals. But so far, the business community is able to operate with a little bit more free rein than it did under Biden, right?
Yeah.
You and I have talked about this before.
Yeah.
But that hold my beer thing.
Yeah.
That people say. The first term of the Obama administration set an all-time record for the pace of substantial government regulation. And then Biden said, hold my beer.
Yeah.
And the Biden administration's regulatory track record blew past what Obama did in his first term.
Yeah.
So, as we're sitting here thinking about M&A and business activity and things like that, that's the deregulatory stuff that CEOs in general at the Business Roundtable are hoping eventually become the dominant narrative of this administration.
It's horse trading, and Trump's not the first president to engage in horse trading with corporations.
Read any biography of Lyndon Johnson.
So now U.S. Steel was able to be acquired, and the government kind of got like warrants on the deal or something.
Yeah.
CBS will be able to be Viacom will be able to be sold to the Ellisons, but there is a settlement.
Let's see what happens. The language last night in the Japan trade deal talked about $550 billion of investment in the United States from Japan at the president's discretion. Now, I don't think he really means that, but those were the words that he used to describe it.
Right.
So, we have to kind of be on the lookout for some kind of Latin American approach to business dealings. But, I'm before overreacting, I'm going to wait to see what happens in practice.
All right, let's dive into some of the greatest hits from Eye on the Market.
Okay.
Michael, why don't you take over? So I know you pulled out some of your favorite charts that we revisited over the last
let's
week
start
or
with
two.
this. As investors, we all know that a lot of the errors that we make are self-inflicted. Greed, fear, rash decisions. One of the big ones that you said our clients were quite concerned by was Meredith Whitney. And a lot of times these unforced errors are because we see it on the TV or in the newspaper. Like we people of authority are saying things that sound intelligent and smart and scary, and we panic. So you pulled out Meredith Whitney's 60 Minutes interview. What do you remember about that time?
Well, first, I remember people telling me, you must not want to make any friends in this industry, which was true. What I remember was my email inbox is a direct reflection of the things that people are hearing. Because the more our clients get scared about something, no matter how successful and knowledgeable they are in their fields, for many of them, their municipal investments are their safe harbor. So when they start hearing things negative about the municipal bond market, whether it's credit risk or maybe Obama had a proposed federal tax of 5 to 7% on municipal bonds for people AGI over 250, I start, oh my God, what's going to happen? I get all these questions. And Meredith Whitney, like a lot of other people in the wake of the financial crisis, was looking to stake out, here's the next Armageddon thing that's going to happen. Look at me. And she staked out the territory that you were going to have massive defaults in the municipal bond market. And then it was going to become the biggest single issue in the entire U.S. economy.
We got a million questions about that. This was the scariest thing in the world.
It was. And again, it's this is the safe harbor bedrock for a lot of client portfolios.
Yes. Risk off. This is the risk off piece.
Right.
And now you're telling people the default rate could be 20% or something.
Or she had some massive number.
Yeah.
50 to 100 large municipal defaults. And it didn't ring true to us because when you dug through the details, it just wasn't there. So the next thing that happens, of course, is Detroit, files. But Detroit was so different in ways people may never be able to appreciate than the other large municipal issuers, even places like Cleveland, Baltimore, and Pittsburgh. Detroit was so different. So we went and we pulled reams of data across all 350 MSAs, which are the metropolitan statistical areas in the country, from the BEA. And we looked at the size of the labor force and labor income, tax payments.
Violent crime.
We looked at everything. And Detroit consistently ranked below the 5th percentile in almost every metric. And in a way, Detroit just was not in any way a bellwether for most of the rest of the municipal issuers.
Right.
And it took that level of detailed research and a long report that we wrote called How Different is Detroit that we had to send out to all the clients to get them to be comfortable with the fact that we were going to kind of have a business as usual approach in the municipal portfolio. And the subsequent 12 to 15 year default rate in the municipal market is 0.1%.
Yeah. So what people need to understand about how meaningful your piece was in that moment, in 2011, Meredith Whitney is 4 years removed from having made a huge call. She was a sell-side analyst covering Citigroup. Where did she work? Merrill or Oppenheimer? Somewhere.
I don't remember.
But she basically called Citigroup on their balance sheet, on their solvency, and I think she predicted the demise of Citigroup, which of course, like many other banks, ends up getting bailed out. So she's a cause celebre.
Right.
Celebre. Cause celebre. She's everywhere. She's like right up there with Rubini and all the other people that got credit for quote unquote calling the crisis. So her then saying, "Here's the next crisis," has a lot of weight.
It did. But in the same as the music industry, a lot of your listeners probably love watching TV shows or reading blogs about one-hit wonders in the music industry.
Well, that's what she ended up
There's
being.
a lot of one-hit wonders as investors, and there's one-hit wonders as strategists, and they have this amazing call, right place, right time, and then they spend the rest of their careers trying to create another one.
Well, that's what happened after the GFC. You famously made this chart.
There were 15 of those.
The consequences of listening to the Armageddonists.
Yeah.
And a lot of these people they're still saying the same thing, but the market seems to.
Are you going to show the chart?
The market seems to not really care about them anymore. They don't get a lot of airtime.
They did. They used to.
For sure. Even 5 years ago, they were still
getting airtime. Do you want me to explain
airtime.
what this is?
Please.
Okay. So what we did was we took the date, the actual date on which people said an Armageddonist type thing, which is 100% chance of recession next year. I think people should have a zero weight to equities, all of those kinds of things. And then from that moment, we went long duration bonds and short the equity market. And then this is what happened if you had listened to those recommendations and then not adjusted your portfolio since.
Right.
Other people have done this kind of thing similarly. I just felt like doing it myself.
In defense of some of the people on there, that wasn't the last thing they ever said.
Right.
That's right.
Right.
Some of them died.
Some of the best.
So do you think that, because you don't hear from these people too often, David Stockman, when's the last time he's been on TV? Do you think that investors have gotten much better at staying invested, at holding through the ups and downs, or is their extinction more a reflection of not better behavior, but the market environment?
Well, to their credit, we lived through this period of financial repression that essentially put real rates below zero, that changed the reaction function in the markets. And so a lot of those people might have been right if the Fed had insisted on maintaining positive real rates like they had for the prior 50 years. But the fact is they didn't, and they were kind of flooding the system with money. And I think from our perspective, because remember I'm covering both our private clients and our institutional asset management clients, whether it's endowments, foundations, insurance companies, and sovereign wealth funds and ERISA plans. Yes, there's more tolerance to hold through volatility than there used to be. And there's also less liquidity. And I think people have learned as asset allocators, it's very hard to kind of, okay, I'm going to sell here. I'm going to wait till it goes down. I'm going to buy it back again. And the market liquidity after the financial crisis is not there. After Silicon Valley Bank failed, I don't want to go into too much detail, but we tried to acquire a substantial, meaningful position in the preferreds of some of the other banks, and it was almost impossible to do, in spite of what the Bloomberg screens were telling you they were available at. So in a world where the market depth isn't there, you can't kind of do that as much horse trading at the asset class level as you might have done in the past. So yes, people are kind of more willing to stick with positions through good and bad.
Yeah, I also think the retail component of the market, I think the retail of this current generation, they're bolder, tend to want to take more risks and do crazier things.
And by the way, ETFs also are a big part of that.
Right, and that's the other component to it is just the reflex of, okay, rebalancing into stocks, they're down, buying my ETFs. Okay, let's talk about geopolitical risk. One of the takeaways, geopolitical risk is a generally poor signal for investors. We obviously agree. We do tons of content. Anytime something is going on geopolitically, people get nervous. Of course they should, because something is volatile in the world, and maybe this means I should take less risk. And of course, it very rarely works out that way. But you specifically looked at this in 2014, looking at two major conflicts in the post-World War II era. And tell us what you found.
Well, there's the counterpart to Meredith Whitney in this space is a guy named Ian Bremmer.
Yeah.
And Ian Bremmer a lot of times will say things. This is the biggest year of geopolitical risk in the post-war era. Maybe, but that doesn't necessarily translate into market risk.
Yeah.
And I think sometimes investors don't try to think about that in a systematic way. So we looked at all of the post-war geopolitical events, and with the exception of the Arab-Israeli War of 73, none of them really had a lasting impact on the financial markets. And this was, something that we did in 2014.
You think Middle East episodes don't impact the market because energy is such a smaller component, both in terms of us producing and just the sector is tiny?
Well, first of all, if I had told you 2 years ago what was going to happen in Israel and Gaza and Iran, I think you would have guessed in the old days.
Crude oil 150.
That's right.
Yeah.
Right.
100%.
Like, you remember Arjun Murti at Goldman had a $200 price target for crude. And so, so people tend to overestimate the impact of some of these geopolitical risks. And second, I do agree. If you look at a chart of oil consumption per unit of global GDP, right, the world gets more energy efficient every year. There's also some substitution going on slowly for whether it's gas or electrification for oil consumption. But in general, there's just not a lot of evidence that geopolitics drives markets for more than a few weeks.
Yeah.
No matter what the events happen to be.
I think saying Middle East also is like probably not helpful from an investing standpoint. Iranian oil is technically not even on the market. If there were a conflict that involved Saudi Arabia, crude oil might react very differently.
That's right.
So
yeah, I mean, there is this issue that the vast majority of Saudi oil is located in the eastern province, and the vast majority of the people that live there are Shiites.
Yeah.
And that piece of territory happens to be in close proximity to Iran, right? So those are real issues. But I'm much more concerned if I had to pick one geopolitical issue. If I wake up one day and I find out that China has imposed a naval blockade on Taiwan, which I expect them to do before the decade is out, I'm much more worried about the market reaction to that than anything that would take place in the Middle East.
You expect them to do that within the next 5 years?
I think so.
How does
that's a personal opinion.
Yeah,
that's
sure.
not the opinion of the firm or JPMorgan or its employees or its anything.
So there are some cases where geopolitical risk would have an enormous impact on the stock market. In my opinion, that would be one of those.
That would be one of them.
Yeah.
Why? I don't know.
Well,
why?
there's only 4 months a year where this can be done.
You like iPhones?
For weather and tidal reasons. There's only 4 months a year when this could happen. Taiwan used to get 50% of its electricity from nuclear. And they decided to unilaterally reduce that to 5%. So they have effectively abandoned a lot of their energy self-sufficiency because now they're big importers of LNG. And I think I read that they have something like 12 or 18 days of coverage for natural gas. So it wouldn't take very long for a naval blockade to kind of bring Taiwan to a screeching halt. What happens there, I don't know. But I don't think that the Chinese government has infinite, endless patience with the status quo. That's the signals that they're sending.
This is one of those things where the hardest hit sector would probably be technology, at least initially.
And then you'd have to see, like, where does it go from there, right?
Yeah.
What would happen to export policies and import policies for semiconductors? We don't know. Think about this. There's so much discussion about Europe and its pre-Ukraine war exposure to Russian energy. So about 25% of European energy came from Russia before the invasion. The world is 70 to 80% reliant on Taiwan for advanced chips.
Yeah.
So it's in another league of dependence.
Yeah.
And so now, there are scenarios where naval blockade or not, Taiwan is still able to supply the world with advanced chips, but that's the question.
Okay.
Do you want to get to
next
how
one.
markets bottom, or do you want to do your indicator stuff?
Let's do
Either one.
Let's do the indicators. So I think people want to hear about
All right.
that.
So
Which are kind of, that one.
yeah. All right.
This one was interesting.
Go ahead.
And for all the right reasons, the markets were really focused. And you remember this, it was just 2 years ago. In the summer of 2023, yield curve is inverted. And the yield curve since 1966 has a perfect papal infallibility record, 8 for 8 in predicting recession.
We've had Campbell Harvey on the show a bunch. So,
Okay.
yeah.
And I think the SOM rule was flashing then too, or was that the next year? Either way.
Event shortly thereafter
Yeah.
started. And by the way, even Claudia came out and said, people are misreading it. But so 8 for 8, inverted yield curves predict recession within 9, 12, 18 months. But we went back and we looked at what was going on at the time of those recessions. And this time just looked different. And so dangerous to say this time is different, but I had no choice. This time looked different.
23.
in the fall of in August 2023, we wrote this Rasputin piece because it was evocative of how higher interest rates were not killing the U.S. economy, right? Because remember Rasputin, he was kind of stabbed, shot, drowned, and poisoned before he died.
Couldn't get rid of him.
Like Nordberg.
Yeah.
So what we did was we said, well, wait a minute. In the past, when the inverted yield curve caused a recession, it was because the front end real rates went very high. Whereas in 2022, they were barely above zero. So yes, they raised them, but raised them from -6 to plus 0.2.
The base that they came from had never been the base for a prior episode.
Then, chart at the lower left. In the past, every time the funds rate went up, you saw evidence that corporate interest payments were rising.
This was the craziest chart of all.
But during a decade of financial repression, who didn't know that they were supposed to term out their liabilities?
Refinance,
the Fed did it.
Out.
Here's the funny part. Who did it? The Fed, corporations, and households.
Yeah.
Who didn't do it?
Banks. Yeah.
Right? So the banks in general were the worst asset liability managers during this period of financial repression.
Yeah.
But as you can see here, yes, it's bad that the policy rate was shooting up, but corporate interest payments as a percentage of profits were still falling.
Yeah.
So the transmission mechanism from rising policy rates to recession wasn't there. And maybe the most important one of all is the chart at the lower right, which is in the past, why did rising policy rates cause recessions, right? It's because at the time the Fed raised rates, it was a shock to the system and the corporate sector was offsides. A negative number means that the corporate sector has a negative financial balance, which means they're spending a lot more than they're earning. In 2020, the corporate sector was in surplus.
Yeah.
So in the past, Fed raises rates, companies are offside, radically retrench capital spending and hiring.
Because they have to borrow and they have to pay more for borrowing, which would raise the hurdle rate.
Right.
You would say, maybe we don't need to do this expansion of our business.
This time around, they weren't worried about that because in aggregate, the corporate sector was in surplus. So we felt that there wasn't going to be a recession. And then we had the eye on the market the next January was the pillow talk one about the bears falling into the pillow.
Yeah. And
that turned out to be the right call.
And you had corporations like Apple and Berkshire Hathaway with hundreds of billions of dollars in cash, where actually higher rates was more net income.
Right.
And we have never seen anything like that before.
That was very out of consensus at the time. Everybody expected a recession.
Everybody was
all right, so what indicators do matter? You have another chart that shows some of your favorites. Let's talk about these.
Yes. Now, these shift around depending upon what time period you're looking at. But we try to run these here. We did this one over almost 30 years. And we run these over a long period of time. And we're trying to figure out, if you didn't know what was going on, but you just invested based on these indicators, would you make or lose money? So for example, when the leading indicator index is above average, you make 1.6% a month investing in the S&P, compared to when it's below average, you only make 0.4%. So
that's a good indicator.
It's big.
So it's a good indicator.
Yeah.
What I love about the geopolitical risk index is the sign is negative, right? You actually would lose money if you didn't invest when the index was high. So it sends you—
High meaning more risk.
More risk. It's sending you in the wrong direction.
Yeah.
And it doesn't mean that it would never work, but over long periods of time, there's just no benefit to the signals.
So for the people listening to this, not watching it, some of these other quote unquote good indicators, CEO confidence, payroll growth, GDP growth, forward 12-month profits growth expectations, small business optimism, most of these are intuitive.
Yeah, that's right.
Most of these, you just assume if I invest during a period of time where this indicator is rising, things are good.
That's right.
Isn't that most of the time?
Most of the time this works.
Most of the time these things are
pretty
positive,
reliable.
not negative.
Right. And this is the thing that feeds into that semiconductor looking chart with all the symbols on it.
So we just mentioned that no indicator is infallible. Nothing works forever.
Right.
To me, one feature of the market that I would say is permanent, works today, worked 100 years ago, will work 100 years from now, is that the stock market will bottom well in advance of everything else. The stock market will bottom and rebound, and the news will get blacker and blacker and blacker, and you'll say, what the f*** is going on? Why is the Dow up 300 points today?
They'll say disconnect.
Stock
in the
rallies on terrible news. Well, yeah, that's what happens. So talk about this.
Well, I think my favorite one of all.
This is a great group of charts.
And we have charts here that go back to the Great Depression and the in the compilation, which people can find online if they look for it.
Yeah.
We included a whole bunch of charts from the Depression. Same thing. But look at the chart at the upper right, okay? So if you look at the S&P Bank Index, right, whether it's the S&P Bank Index or you can look at the KBW, same signal. That index bottoms in early 2009 at a time when only 8% of the eventual bank failures had taken place.
Mm.
It's the most bizarre anticipatory signal in the equity market that I've ever seen. Part of it was driven by the SCAP program, which was, the Geithner-sponsored recapitalization of the banks and things like that. But you see this again and again. At the lower left, it works in Europe too. In Europe, the European equities bottomed during the balance of payments crisis in 2012. And it took another 2 years before the unemployment rate, which is a horribly lagging indicator, stopped rising. So you just see this again and again and again. And it's, actually the one on the left, on the upper left, that one's from the Depression. So only half of the bank failures had taken place by the times the Dow Jones had actually bottomed. So you just see this again and again.
So with stocks, it's hard to know what amount of risk is pricing. It's hard to quantify that. But with credit markets, you can, and you did.
Yeah.
So this is from December 2008. And this is just math. So talk about, I'm sure you remember this very well.
Yeah.
What did you see and what were you saying to investors about what sort of risk was being priced
This
in?
was one of the only times that I can actually remember begging. So we were begging our clients to read this eye. Please read this eye in the market. You don't have to do anything, but you have to promise me that you're going to read it because you're never going to see a piece of paper like this ever again. Okay. And I understand the level of shock. Okay. So let's not be too much 2020 hindsight. It's December 2008. We're now looking at the second 40% decline in equity markets within a decade, something that hadn't happened since the Depression. And, I consider our firm to be pretty smart. Our firm bought $2 billion of Fannie Preferreds over the summer that eventually got wiped out, right? So even JPMorgan didn't understand the depths of the problems at the GSEs. Now, that said, like you said, where were things priced? Look at that investment grade, first row, investment grade corporate bonds.
Implied default rate
was
14%.
14%.
Right.
And the worst ever.
The worst ever was 3%. And we were assuming a 20% recovery rate. I mean, investment grade bonds rarely default, but when they do, the recovery rates are well north of 80%. Let's look at high yield. The implied default rate was 55%.
Which is like the end of the world.
Right, end of the world. So now, there were some discussions.
Like the worst ever for high yield junk bonds.
Yes.
The worst ever default rate in reality was 34%.
And this is pricing at 55.
And this was pricing at 55. Okay.
So now, if you invested then, you couldn't have any leverage at all because a lot of the pricing still deteriorated until March. So we made clear that when we were investing and when clients did it on their own, that you can't lever this at all. In these
Also,
kind of
wherever you got the leverage from, they could pull it.
Yeah.
Which is another risk, counterparty risk.
So you have to have the discipline
Yeah.
every time something blows up to say, what's the embedded pricing assumptions, particularly in credit, because they'll just kind of jump out at you. On equity markets, you had the thing on the right, which is that the markets were basically pricing in zero forward earnings growth after, 26 years at 10 to 15%.
Jim Chanos said in bull markets, people put a premium on promises, and in bear markets, they put a discount on reality.
Yeah.
And that's what that is.
I think so.
That was a pretty remarkable time.
It was.
So as you were begging people to read this particular piece, did they?
Yeah, they read it. They all read it. And some, and look, we are in our business, we have a combination of discretionary funds that we oversee, that we control, and then we have other funds that are self-directed. And so, we did what we were going to do in our discretionary business, and some of the self-directed people came along and for the ride as well. Another similar episode when Lula was first elected in Brazil. Remember him?
Yeah.
He's back. But when he was first
Lula da
elected in
Silva,
Brazil,
yeah.
1 year default protection, which is the equivalent of going long a corporate bond, you could sell 1 year default protection in Brazil for 30%.
Really?
Right. That's how much fear there was around Lula. We went out to all the clients. The only people that did it were Brazilian.
Okay. They weren't as worried.
They weren't as worried.
Okay.
So let's assume at some point in the future, there will be another downturn.
Yeah.
The stock market will fall. The economy will contract.
Right.
You wrote bank equity injections had historically been much more successful in boosting real GDP growth and boosting equity markets than government purchases of bad loans from banks.
Yeah.
So my question to you is, do you think that the next rescue plan will look more like '08, where we have all these programs and you have QE and monetary stimulus, or will it look more like 2020, where there'll be more fiscal stimulus, which obviously had a much different and larger impact?
Yeah.
Depends on the nature of the crisis.
Yeah, but I understand the question. To me, I don't think you get an alphabet soup approach like 2008 again, because think about all of the stuff that was taking place in the financial sector back then with GE Capital and with Wachovia and WAMU. I mean, WAMU was underwriting mortgages and they were making 3% on them at a time when the rest of the banking industry was making 0.5%. Those are some pretty funky mortgages in order to be able to make that much money. So a lot of the kinds of things and derivatives particularly that have now been all moved on to centralized exchanges instead of being bilateral, I don't think you have the same kind of risks in the banking system. And by the way, look what's happening with private credit. A lot of the cuspier bank loans that used to exist within the financial system have been shunted onto, private credit, where people are dealing directly with investors. So I think the next crisis is not about the banks.
I think I don't fully agree with that part. I think we've sent a lot of the cuspier lending activity out to the private credit industry.
Yeah.
But now there's this recursive thing happening where the investors in those funds are coming from the wealth management operations of the systemically important financial institutions. The banks themselves are not taking balance sheet risk. Their clients are.
Yeah.
I mean, let's be honest.
Yes.
That's
I agree with that.
That's where the money is coming from.
Yeah. I agree with that. But that has different implications.
Agree.
If something goes wrong, it's not a direct implication.
No, rich people have bigger problems than corporate executives.
I guess
on Wall
my
Street.
point is that sending people checks is a much quicker way to stop the bleeding, the economic bleeding. Right. Unfortunately, we did that in a time where people had nothing to spend the money on except to buy stocks. And so, and then in crypto, and then we turned the power back on. There was so much money, not enough supply of goods, and inflation.
Yeah.
Unfortunately, I think that will be the prevailing lesson, is that when you send checks, you get rampant inflation. When in reality, we don't know what would have happened if there wasn't.
They're never going to run that back. It made Biden a one-term president.
Yeah, no, I
never do that
I
again.
understand.
Yeah.
Yeah. No, I mean, what was so unique about the COVID situation is that there should have been a normal recession, but it was short-circuited because of the PPP loans and other things that were done. So that doesn't almost doesn't count as a recession because the normal transmission mechanisms from weak economic growth to rising defaults didn't happen. Yeah. So we haven't had a real traditional recession since the financial crisis.
This says it all, right? Yeah. Like you have a chart that shows the stimulus response to COVID, and there's nothing like it.
No, there wasn't any. We thought that the global financial crisis was a lot of stimulus. Look at that chart on the right in terms of money supply growth.
It's unbelievable. It needs its own. I want to talk to you about the role of humor in your work. You're a funny guy. You really are a funny guy. Because I'm an idiot, this is my favorite thing you've ever done. Do we have this?
Is this CGI where there's really next to you?
Oh no, they're still on my couch in my office.
So this is your Liberation Day tariff webcast.
I bought them on Amazon.
And for the people listening, it's Michael Cembalest with his two panelists. One is a emperor penguin, and the other is that a rook? What do they call baby penguins?
A rook penguin.
It's a rook. So what did you gain? What kind of insight did you gain from your guests that day? What do people say when they see that? Everyone's in on the joke, right?
Well, no, I can't really tell anybody in advance that I'm doing this.
No, of course not.
Just in case, people get cold feet and say, "Oh my God,
I made a whole career out of surprising people rather than asking for permission."
I think it was You have to remember the fact. You have to remember how we got here.
Yeah,
okay?
yeah.
So Howard Lutnick comes out with the cardboard thing, and here are the Liberation Day tariffs.
Yeah.
Okay. Again, the president ran on, I love McKinley. McKinley was the father of the modern tariff. I don't have any problem with the president implementing policies that he ran on and the voters said they wanted.
Yeah.
The issue is, how do they do it? So they come out with these Liberation Day tariffs and they say, we're doing it based on this formula. The morning they get announced, I actually get an email from the guy, the academic who wrote the formula that they based it on, and they completely botched it.
Yeah.
The formulas would have been the Liberation Day tariffs were 4 times higher than they would have been had they correctly interpreted his work.
But they were looking for bombast. They weren't trying to say something that was formulaically accurate. They were trying to get everyone's attention.
Then don't put a formula in the footnote.
Well,
okay,
you got to base it on something. You got to base.
Well,
it
then
copy paste.
But so the joke
anyway.
here is the McDonald Islands.
Nobody
lives
the herd
there
in
other than
McDonald
penguins.
Islands were included on the initial.
How did they get on there?
Well, because they
Because they don't
basically
give a shit.
they basically had some 19-year-old intern grab a list from Wikipedia of all of the countries that exist and paste them into a thing. And they said, let's put tariffs on everybody. And that's how it showed up. And I just think that if you're going to do something like this, that reverses 100 years of policy, you should have somebody, who is able to rent a car, do the analysis, right?
Yeah.
We have to be 25.
Yeah.
So do it right. Find somebody that will substantiate what you're trying to do and do it responsibly. And I didn't think they were doing that. So this was my way of suggesting that it could have been done better.
The market reaction to that was chaos.
Yes.
Because the rollout was chaos.
Yeah.
What do you expect? Right.
Right. Now,
Okay.
that said, we had a 20% correction. And then, I went back to the toolkit, and on the webcast that we did, on that same webcast, I showed a chart saying, going back 100 years, every time there's a 20% sell-off, 85% of the time, a year later, the markets are higher.
Yeah.
So for all the concerns that people may have.
Nobody has a problem with that. The problem with that is, does 20 become down 40 first? That's the issue. It's not will we recover. It's what happens between now and the recovery. Does it get way worse?
But an 85% success and a 20% sell-off covers a lot of sins.
You just buy
economically and earnings, and so we felt that it was enough to justify some additional risk taking.
All right, there's another one I loved in real time when you did it. I think this one spread like wildfire. I picture the FT Alphaville people who I'm friends with. They must wait with bated breath for the next Michael Cembalest during a European financial crisis. This is your son's Legos.
Right.
And you basically construct this hierarchy of who has to bail out who to save the European financial system. And for people that are not watching this, they're listening to this, Michael's got every relevant group, Spain and Italy, the German parties, Finland, the German Social Democrats. You've got the European Central Bank, and they're all represented by various Lego
stormtroopers
characters. There were
Right.
stormtroopers on here.
I was
Wait,
on.
who are the stormtroopers in this? The EU Commission.
Yeah,
they must have loved that.
This didn't go over super well in Europe, but this. Okay, so first, a couple of important things. Normally, I wouldn't have the time to do this because this took a lot of time to stage. But it was during one of those LIPA blackouts on Long Island.
Oh.
And so we had plenty of time. What's that?
Was this Sandy?
I don't remember exactly what was happening, but we had a 5-day blackout.
Okay.
And I had plenty of time for this kind of diorama work. Second, this was actually part of one of the most important decisions that we ever made was there was more carnage in the US than in Europe during the financial crisis. And a lot of people were overweight Europe and stayed that way for much of the decade. In 2010, as you saw in the compilation, I did not like the dynamics that I was seeing, which we can get into, but we were violently and massively underweight Europe compared to the US and have been since then. I don't think there will ever be an asset allocation position that we will have in portfolios that will ever make as much as what we've made on that. And so that funny looking diorama was one of the pillars of the reasons why we were so confident being underweight.
Your conclusion was that the U.S. stress tests were
real.
Very real.
Geithner, to his credit, used a 9% default rate, which had only happened during a brief period during the recession, to stress test.
But what that did is it forced the banks to raise too much money.
To either raise capital or dedicate pre-provision income to rebuilding their balance sheet.
In Europe, they were smoking crack. They assumed a $3 billion loss for the banks.
For the entire financial system of Europe, they said the capital shortfall was $3 billion.
I'll do you one better. They were raising interest rates. They were worried about inflation in 2010.
The other thing, and I don't think you put it in the deck, but the other thing that people can see in the compilation that's amazing is if you go back before the euro and you look at things like industrial production and current account deficits, the North and the South moved the same. They put the euro in place and then they broke apart. It's actually a textbook definition of the opposite of what a currency union is supposed to do. A currency union is supposed to force all those macroeconomic variables to converge the way they did. Remember, there were multiple dollars in the early 1800s.
Yeah.
And as the regular dollar became the standard across the country, inflation and growth and income and all those metrics across the United States and different regions started to converge.
Yeah.
In Europe, they blew apart. And so that was a signal to us that something was seriously broken. And that brokenness would, in fact, affect earnings and multiples and everything else. And boy, I mean, that I'm comfortable with that diorama and our positions in Europe being put on my tombstone. That's how much money we
have a chart showing the absurdity of you showed the dispersion between European countries was further apart than if you had just created a currency based on all the countries whose first letter is M.
That's right.
Like you said, these countries have so little in common that if we just took the M countries around the world, that would be a more cohesive.
Or the countries at the 40th latitude. I mean, you can create you could reconstitute the Ottoman Empire.
But that ended up being the right allocation call because it's effectively a dysfunctional situation.
It's a political vision, right?
It's not an economic
reality. In a way, it's there are wonderful things about the European vision. You know, similarly, Europe is leading the world in decarbonization, right? And there's a chart in the compilation. Europe is leading the way with respect to renewables displacing other forms of fuel. Europe's also leading the way in terms of industrial shutdowns and departures, right? Yeah. Europe's also leading the way in the cost of electricity. So Europe has certain political objectives that at times override market and economic objectives. And as investors, we have to be able to respond to that.
The front page of the Journal today, the big debate in Europe is air conditioning or not. So this is an example of what you mean.
Can we just spend a minute on that?
I would love to.
So that people understand what's going on. Something like 90% of homes in the United States have air conditioning, even in really northern climates. In Europe, that's not the case, okay? So you have fossil fuel-based heating. So there's a huge push in Europe for people to electrify their home heating with a heat pump, right? So for everybody listening, what's a heat pump? A heat pump essentially is an air conditioner that works in reverse, right? And it's very efficient. It can convert 1 unit of heat into 3 units of electricity. So it's a very kind of energy efficient device. But if you give people these heat pumps for their winter heat, they'll just flip them and use them as air conditioning in the summer. So we ran some numbers, and for countries like for Italy and Greece, all the CO2 emissions benefits that they would get from pushing these more efficient heat pumps would be lost if people start using air conditioning.
In July and August.
And is a classic unintended consequence thing that you see in Europe all the time.
Right. So I want to, I know we have
That's a good transition. Let's end on leadership.
Yeah. Let's do this.
Already done?
Well, you gave us the heart out. We don't have one.
No.
Michael and I'll sit with you all night. Let's do this thing about what was Lehman doing, because it's a great segue into the leadership at what was JPMorgan not doing that Lehman was doing. And you were there at the time. So I think that's a really great lesson for investors to take from this.
Well, part of this dates back to the first Bush administration, and you guys will probably remember this. Before 2004, there used to be something called the broker-dealer net capital rule.
12 to 1.
12 to 1, exactly.
That's the max leverage a broker-dealer could take.
That's right. Forget about risk-adjusted, like 12 to 1, hard stop.
Which is a lot already.
Yeah. And under the first Bush administration, the broker-dealers were effective at lobbying the SEC, and they rescinded this rule and essentially put in some squishy, touchy-feely limit. Within 2 years, all the big 5 broker-dealers were 30 plus in terms of leverage.
Lehman, Merrill,
Goldman, and Morgan Stanley.
Okay.
So part of the backdrop was understanding how what looked like a footnotey thing in the journal about a change to risk-based capital rules had this seismic impact on what was going on in the actual markets. And we saw it, and that was also kind of a scary thing that was taking place. And, we responded by kind of gradually pulling in our horns heading into the financial crisis when we saw this. The reason that I put together the chart on the right was all the banks were essentially bum rushed into taking the capital, whether they needed it or not, with the exception of U.S. Bank, which was the one bank that said, no, we won't take it. But not all the banks are the same. And Jamie gave a couple of talks where look, we'll take our lumps and we will continue to take our lumps. But putting all the banks together in one boat and kind of blaming them for everything was what didn't make sense, because it was a very heterogeneous group. And look at this chart, right? There was that giant alphabet soup of all the facilities that were required. Citigroup, Merrill Lynch, and Morgan Stanley and AIG, used the vast lion's share of this. And so, at the time that we published these charts, we said, look, we have issues like everybody else, but there are differences in terms of how banks run themselves and how they manage risk. And these were some of the charts that we used at the time.
So in your compilation, you point out that Lehman was running at 35 to 1 and in one part of their business, 100 to 1.
Yeah.
And JPMorgan was not doing that.
No.
I want to ask you if this is true. There's an apocryphal story that I heard from someone who was working on a trading desk at JPMorgan right in the heart of this, the run-up to the crisis. And Jamie was taking a tour, as he frequently does, and just talking to people on every floor. And he asked somebody to quote something, probably a bond, maybe a mortgage, something. The trader gave him a quote of where it was trading, where it was being valued. And this is at a time where people were worried. And the way he tells the story, Jamie said, "What's the price?" He quotes the price. Jamie said, "Oh yeah, sell some." He said, "What do you mean?" He said, "Well, let's see if that's the price. Sell some." And of course, the trader can't get a sale off at that price. And that was kind of like a microcosm, I guess, of a bigger story where JPMorgan realized where the market was versus where the reality was were not the same things. You believe that? You think that story's true, or something like that might have happened?
I haven't heard that one, but
Okay.
It's
a good one, though.
Having seen Jamie in action, it's entirely plausible. He is very involved on a detailed level in terms of, when he meets with management teams and they present to him, put it this way, that experience is entirely different than that same experience with these CEOs that preceded Jamie. Everything about the level of preparation, the consequences for being unprepared, and the kind of questions and due diligence that are going to be asked of you, that changed radically.
So on leadership, he stands so far apart from the other leaders of that era. One of them was the best golfer in the world, apparently. We won't name names. One of them was a world champion bridge player. Jamie didn't have the reputation for having those hobbies. He was focused on the risk taking within the bank and what to do about it. And they're the last one standing, literally.
Yeah, I've mentioned this before. My job requires me to know a lot of things about a lot of things and do so pretty deeply. And there are a lot of times when I need to reach out to people and get help on certain things. Sometimes something will happen and I'm starting out, with a deficit of knowledge that I have to build really fast. A couple of years ago, remember when Credit Suisse blew up and there were the COCO bonds, which were the European version of preferred stock, but they were kind of different than the way U.S. preferreds function.
And nobody had ever heard of those.
The devils are in the details. There's a lot of times when I have to get up to speed on something really fast. And or something within the energy space, and I need to understand really quickly how some new technology might work. The halo effect that Jamie has created for the firm over the last 20 years is amazing. I can call people and say, I'm the chief investment officer at JPMorgan Asset Management. Will you talk to me? And almost always the answer is yes.
Yeah.
And I attribute that having nothing to do with me, because they most of the time never heard of us, but because of Jamie and the impact he's had on the organization, they return your call. And one of the only times that people that didn't work was
You called Elizabeth Warren.
I'm not going into that.
Okay.
During the summer of 2008,
Yeah.
we were getting a lot of calls from clients. Why can't you guys make 11% annualized return with a 2% vol like this Madoff guy? And so I said, well, I don't know. Let me look into it. So I start looking into it. I can't find any information. And, the whole thing is very sketchy. I went on to the early version of Google Maps, and I looked at the building in which the custodian was allegedly housed, and it was the back of a Chinese restaurant. So the whole thing seemed really kind of funky to me. So we said, okay, let's do a due diligence trip. So we get in the car and we go up to Connecticut to see the feeder fund. They had that.
Yeah.
I'm not going to mention any names, but there was that feeder fund.
This is the fund that's raising money from people and passing it over to Madoff.
Right.
Okay.
And we had like a 19-section questionnaire that we wanted to ask, and the first one is, can we meet the principal? And the answer was no. And I said, well, okay, we're leaving. Yeah. And they said, well, no. And we got up and we left, because if we can't meet the principal and talk to him, the rest of the questionnaire is irrelevant. So I went back and I put some notes in the files saying, like, I don't understand what's going on here. And I drew a picture of a unicorn on their total return chart. And I said, I don't get this. This doesn't make any sense.
Yeah, it looks like private credit.
Right.
But
wait, hold on. So
he's a $50 billion fund then too.
Right.
It's
so
not small.
I just drew a picture. I'm not even a good artist, but I drew a picture of a unicorn, put it in the files, and forgot about it. And then eventually the SEC ended up deposing me.
What did the chart look like? Just saying, up and to the right?
Up and to the right. It was the 11% annualized return with 3% vol.
Yeah.
And I got deposed by the SEC, who wanted to know what I knew when and why didn't I tell everybody and what was going on. And, I answered all the questions. I mean, there wasn't much to say.
They wouldn't talk to you.
They wouldn't talk to us. But at one point the deposition kept going on and on and on. And I said, well, why didn't you read the Harry Markopoulos note from 2001 that said Bernie Madoff is a fraud? And the lawyer that was representing me in the deposition almost had a heart attack.
Yeah.
That was the end of the deposition.
Yeah. Michael, this isn't what we're here to do. We're not here to score points.
By the way, if I could just say a couple of other things.
Please.
My favorite of all the pieces in there is the one on why the financial crisis happened the way that it
17
did.
We have this. We liked it too.
This is my favorite eye in the market. And the reason it's my favorite one of all time is the public narrative from the government and all of its agents and both parties was the private sector did it. The rating agencies are responsible. The banks are responsible.
Reckless bankers.
Reckless lending.
Yeah.
It was policy.
Now, you'll have to read the piece because this is like a spaghetti chart. But I want to show you something here. Those red lines are rising. And now we're looking at the 90s here up until 2005. These represent the portion of Freddie and Fannie underwriting that is effectively subprime and Alt-A risk. This is before, look at the black line, that's the private sector. So the GSEs loaded up on Alt-A and subprime risk way before the private sector did. And why did they do it? Because of the blue line of the GSE low and moderate income lending targets that Congress established. And there's a quote that we pulled from the year 2000 from the HUD reports that is the most amazing smoking gun I've ever seen in the history of smoking guns, where they say, let's have the GSEs do subprime type lending without calling it subprime, and we will eventually lure like the sirens, we will eventually lure the private banks to their death.
This
by
was
doing
Bush, the ownership society. This
Yeah.
was George W. Bush extolling the virtues of home ownership, and we need to create more homeowners.
This was a combination of Clinton and
Bush.
Right. And by the way, Andrew Cuomo was the head of HUD when some of these things happened.
Mm.
So, and to read about how aggressively the public sector tried to, after the financial crisis, change the history of what actually happened, I'm glad that I had the historical records to kind of show, no, that's not what happened.
Yeah.
This is what happened. And, there are some lessons to be learned here about risk-taking and risk underwriting and things like that. So I love that one. There was also a piece at the end for how I ended up in the asset management business that's also worth learning, that has to do with a piece of candy.
That was a funny story.
In the lunchroom.
So, Michael, we think this is just an extraordinary document, and it is the culmination of decades of your work, and it's just incredible. Where does the artwork come from? Because that's a really big part of the presentation.
It's ChatGPT.
Right. Well, no. For the vast majority of the history of the eye in the market, we would commission.
Yeah. Almost like a magazine. Almost
artists,
like a magazine.
Yeah, to draw, and they're beautiful. And then more recently, we've been using ChatGPT just to do certain things. But I hire artists once in a while. There are things that GPT can't do.
Can we get 20 more years?
Yeah.
10?
What do you think?
10?
Keep going?
No, there's a lot of
What else?
There's still a lot of fish I've never caught. I've never caught a permit, which is on my list.
You could do both. This time.
Go catch a penguin.
I'm going to. I'm going in late August. I'm going to British Columbia.
Okay.
To catch on a kayak. I'm going to fish for sturgeon, like 7 to 8 foot sturgeon.
Okay.
So I've done it before, and almost it was pretty dicey. So I can't. I'm looking forward to trying it again.
Well, on behalf of everyone on Wall Street, everyone off Wall Street, anyone who's ever read Eye on the Market, anyone who's a regular reader, Michael and I, and we here at the compound would just like to say thank you for your extraordinary contribution to our knowledge. I get smarter every time I finish reading one of your pieces. I learn something, and I
want to thank you because I kind of like Boo Radley. I lived in silence for most of my career, and you guys were the first place where I went, to talk to a broad podcasty type.
But now you have your own show. How do people find your podcast?
Yeah, let's tell people where they can get more. Michael Cembalest.
I post every Eye on the Market on LinkedIn now.
Yep.
So if you go to my LinkedIn profile, you can find the anniversary piece. You can find and the other pieces that I write.
This is amazing. Thank you so much for being
You're
here.
welcome.
We appreciate you guys. Make sure to follow Michael Cembalest on LinkedIn if you want the latest Eye on the Market piece. And by all means, go and hunt down this 20th anniversary compilation. You can get it as a PDF. It is extraordinary. You will absolutely become a better investor once you've digested it. Thank you so much.